Welcome to Mongo Spaces this Thursday evening. We're here with Ronnie Toka. We want to discuss the bank's first half results. Ronnie, since we last talked, I think you've shifted jobs. So I'll give you this chance to introduce yourself to the public.
Thank you. It is a great pleasure to be back on your spaces. Lovely good evening to all our listeners. My name is Ronnie Toka, presently practicing as a senior research analyst at Capital A Investment Bank. I'm an economist by training and I'm passionate about capital markets. It's a pleasure to be here as always, man.
Can you tell us a bit about Capital A, or why not Capital B?
Great. Yeah, Capital A Investment Bank is a recently rebranded franchise, previously known as Securities Africa. We are the leading fixed income traders at the Nairobi Securities Exchange, and they also have a very strong equities desk. We building our presence across the diaspora market, and we are working on a number of interesting products and services that are soon to be launched. We also offer corporate finance services and private wealth advisory.
Let's go to bank earnings a bit. What was your high-level pick from the earnings? What did you observe?
Firstly, I think the first half of 2025 can be characterized as a period where we witnessed a number of shifts. Number one, just to contextualize, it was a period where we had stronger macro normalization. That is to say, a number of our macroeconomic indicators have really reversed trajectory to the favor on even or presenting rather new challenges to a number of our Tier 1 banks. Key among them was, I can describe as the strengthening of Kenya shilling and the stability ever since. It was also a period where we witnessed interest rates take a deep dive. From last year, February, up to date, interest rates have gone down by as much as 6 to 8% on some tenors. And that has really reversed fortunes for banks insofar as, number one, how they price credit and also the yield they realize from the investment securities. This macro normalization had the effect of compressing yields for a majority of the banks. Banks who are able to pass on that decline in their interest rates in the form of lower cost of funds quickly were able to preserve their net interest margins way faster than banks which were slower on that front, because yields generally were on the decline. Yields on interest earning assets on the decline. On the asset quality front, pressures still persisted, with the industry average NPL ratio still rising further to 17.6%. As of June 2025, it remained to be seen how banks contended with these looming pressures. And what we witnessed as a result was a number of banks increasing their loan loss provisions, or that provisions for non-performing loans, as it were. However, we started to see bouts of optimism by some other banks, which I'll also deep dive also in later parts of this discussion.
That's a good setup. Let's start with the FX. I think FX was pretty stable in H1 if you compare to last year, where there's a bit of volatility around the euro bonds and the status, whether they would be bought back or we would be able to finance that. So the FX was pretty stable this year, and so banks didn't see that much earnings. Any observations across board?
Certainly. Ever since, the refinancing of the 2024 Eurobond back in February 2024, and also the subsequent reforms the CBK introduced to the interbank foreign exchange markets that seized indicative reporting in favor of reporting of the exchange rate based on the weighted average rate on trades that actually take back. So that removed a lot of the sentimentalism that used to propel that panic or that slide in the shilling we saw for the better part of 2022 to 2023. So how did banks respond to this dynamic? For the most part, majority of banks witnessed a decline in the non-interest income, which also captures the FX trading incomes. For the large part decline, because given how the shilling has been stable at 129 for the last 18 months, there have been very few opportunities to realize alpha except through volumes. So the tide shifted from a margin game into a volume play.
Oh yeah, and some banks definitely saw a significant decline, especially in FX income. I think it was Stanley that saw around 58% drop. When you look at the components of non-funded income, are there any other components that stood out for you in the first half of the year?
By and large, FX trading income is the bread and butter for the most part, especially for these multinational banks like Standard Chartered and Stanbic. However, another component is usually the trading income on government securities. And for the most part, this element really recovered for majority of Taiwan banks, since as I pointed out earlier, the decline in yields favored a repricing of all our legacy infrastructure bonds and the normal treasury bonds, those which were hitherto undervalued or say discounted relative to their par values, really recovered valuations for the better part of this year. And as such, even if you look at the secondary market trading activity, as of August, we already passed 1.5 trillion, which was the entire of 2024's secondary market trading turnover. This year, we've seen much more trading activity, as it were, because of that decline in yields. The bond market has now shifted from a buyer's market into a seller's market, since most of the bond...
What does that shift from a buyer's to a seller's market mean?
Great. If we look at 2023, when interest rates were edging north of 15, 16%, and in the peak of which interest rates even hit 18% at some point in early 2024, you find that most of the securities which were issued at 10%, 11% coupon were trading at steep discounts. As such, it was more favorable for buyers to get into the bond market. Sellers hesitated to sell unless in the event of extreme liquidity events. So to the extent that most bonds are trading at steep discounts, then that implies it's a buyer's market. It's favorable for buyers. However, as is the case now, due to the decline in yields to even single-digit levels in the short end, most bonds are now trading above their par values at premiums. So it's more favorable for sellers participating in this space.
And then when you look at the interest margins, interest expenses versus interest income, how was that progress, especially as rates compressed a bit? And on that note, also commented on the central bank push to have banks reduce rates as the CBR also declines. Does that have any impact in terms of the interest income across banks?
Great. If we splice the interest income components, one metric we like to track is the yield on interest earning assets, because that communicates to us what is the average yield they are getting on all their government securities and loans and advances, which are now the interest earning assets in this case. Of course, for the longest time, Standard Chartered has been leading in terms of the highest yields on interest earning assets at 15%, followed by I&M at 14% as of half year this year. And in that place, you have Cooperative Bank, 13.8%. What we noticed generally across the board was that the yields on interest earning assets were on the decline. And it's understandable because generally, if you have the central bank reducing the benchmark rate from 13.5% to now where we are at 9.5%, that's over 400 basis points. And there's that forward pricing element. That meant that even if you look at the average yield on new securities issued that the Central Bank of Kenya is issuing bonds at, it's way lower compared to a year ago. That meant opportunities for banks to realize the alpha return they recorded last year was under pressure. So it shifted the nexus to now a volume play. A number of banks increased their allocations to government securities, like ABSA, which increased their allocation to government securities by 70% year on year, compared to the loan growth, which was more modest. Cooperative Bank also increased their allocation to government securities by 25.5%. Of course, there's usually that controversy of lazy banking, where banks simply parking all their deposits in government securities as opposed to lending. But you have to understand there's a risk element to it. If non-performing loans across the industry are in the strong double digits, of course, many banks will shy away from taking up that extra risk. But the silver lining, despite the decline in yields, has been the risk-based credit pricing. What you notice has been that despite the decline in the benchmark rate by the CBK over the past year, we witnessed a very slow reduction in the cost of credit to the private sector. Banks are still lending at upwards of 17, 18% to businesses and personal household loans. And they attribute that, to the deteriorated credit environment.
So then the push in the second half of the year from the central bank, at least for these banks to lower rates, and I think they have from December 1st to start using the new model. What's your assessment of the impact, or at least what you're hearing from banks? I think Stanbic was one of the first to change their models. I think they have a timeline of doing that by February 2026. What's your takeaway from the push from the central bank?
Yes, late last month in the previous MPC meeting, the CBK introduced the Kenya shilling overnight interbank average rate, which is now the new benchmark for pricing of interest rate. It is very timely that we have this benchmark rates being introduced, in my view. A lot of banks had different benchmark rates in computing the average cost of credit across the private sector. And that in itself was a major challenge, especially for clients who don't have multiple bank accounts in different banks, and how much the switching costs are so high, and having to build a reputation in the new bank takes time. So I think the introduction of this benchmark is a very much welcome benchmark in my view. Number one, because all banks are now using the same benchmark to price for credit. So that removes a lot of the arbitrariness and the opaqueness that was usually at play in pricing these loans. The logical extension of that would be that consumers will now have a better basis of comparing cost of credit across different shops. So they'll know if KCB is charging me 17%, ABSA is charging me maybe higher or lower than that, but they all have the same base rates. And even from the CBK's perspective, it is a much favorable benchmark to use, since we expect that from now we'll have better transmission of monetary policy. You reckon that the CBK has the objective of maintaining price stability and also promoting economic growth. That is that dual objective, dual mandate. However, sometimes at conflict, because how do you promote economic growth in an inflationary environment? Obviously, the CBK has to increase interest rates to tame that inflationary pressure that is emerging. However, when they increase interest rates, the demand for credit slows down, and as such, economic growth tends to take a hit. The converse is also true. If at all, yes, the CBK is keen on promoting economic growth as it now is, usually that tends to overheat the economy. Demand tends to exceed supply, then start to see emerging price pressures, prompting now a need for CBK to tighten interest rates at some point. So there's that balance they have to strike. If at all they don't have an effective benchmark rate to use in transmitting monetary policy decisions, then the CBK was in effect a redundant benchmark, because each bank was using their own benchmark. Some are using the 91-day T-bill, some are using a weighted average of T-bill, the benchmark rates, and any other rate they choose. But now that we have a harmonized benchmark, we're even aligning with international best practices at this point.
I'm a bit skeptical about the impact this would have, because the K premium there in the banks is doing the heavy lifting. What's your take on that, perhaps, before we get back to the H1 25 earnings?
Of course, there's that controversy around the K and how banks will be arriving at that risk premium going forward. However, the CBK also mentioned that banks must publish the risk premium and the fee components, including pricing for their profitability margins. I think going forward, we'll have a better comparison basis net. It is much better than the previous status quo, where banks are using their own benchmarks and their own Ks. So at least we've solved one part of that equation. The benchmark rate is standard across. The only enigma will now be how you arrive at that premium K. Banks can only price so far. They can only increase the risk premium so far before competition wipes them out. So I think going forward, banks will have to play more competitively than before if they're all the one to maintain that customer base.
One of the aims of the central bank is to boost or at least revive credit growth to the private sector. From your look across some of these banks in H1, how is lending and credit growth looking like? Is it tepid or is it slightly improved given the push for lower rates?
Great. I think what we've noticed over the first half of this year has been, because of the deterioration in the credit risk environment, banks have been largely hesitant to lend. But of course, there are few exceptions. There are banks which have increased lending, like KCB, which increased loans and advances by 6% on year. And given that base of 1 trillion, 6% is pretty huge. The Diamond Trust Bank also increased their lending activity to up to 288 billion, and Standard Chartered slightly increased by just under 2%. But if we look at ABSA, Cooperative Bank, Equity Group, and Standard Chartered, by and large, they are mostly increasing allocations into government securities and not lending. Given the movement in interest rates, we are now starting to see some divergence in strategy, as opposed to last year when most banks were moving largely in unison. Because of the increased yields on government bonds, they were largely increasing allocations into government bonds. But now that yields on government securities are declining, we are starting to see some divergence. Some banks are more optimistic in terms of even the cost of risk allocations. Some are reducing their loan loss provisions, implying that they're optimistic on loan performance over the coming quarters. Yet you still have some pockets of doubt. Some banks are still raising their cost of risk allocations. If I contrast, for instance, Standard Chartered reduced their cost of risk, understandably, because Standard Chartered it has uniquely the lowest NPL ratio in the industry at just 4%, which is pretty unique. I've only seen this low NPL rates in Tanzania, for instance. So a 4% NPL ratio in Kenya is pretty decent. And as such, we are also seeing them reduce the cost of risk allocations. If I check KCB actually recorded a decline in the NPL ratio from December to June. Partly this we attribute to the sale of NDK, which also decimated part of the weighted average deteriorated loan portfolio. In terms of the cost of risk, that also declined from 3% to 2.3% KCB, implying that they are also optimistic that loan performance will improve and that the NPL ratios will start declining as interest rates cool off. If I look at Equity Group, witnessed a very steep rise in the NPL ratio to just under 16%. But at the same time, they are lowering their cost of risk. So they're optimistic despite a deterioration in their asset quality. But this could be due to single obligor risk, which they could basically intensify to clean up on those few deteriorated accounts. But generally, the sentiment in the market and banking management is that despite the deterioration in asset quality, we are approaching a turning point, and forward quarters will have much lower NPL ratios. That is what you are getting based on the tactical decisions surrounding loan loss provisions.
A quick one though, why aren't banks lending, or to put it in another way, why are businesses not borrowing from banks?
That's a good question. I just saw a survey today which indicated that 63% of respondents indicated that they are reducing their borrowing activity from commercial banks. I think even saw it on your page. Part of this has to do with the pricing. A large part of it has to do with the pricing. Once it gave way to the risk-based credit pricing methodology, it opened a Pandora's box. So on the banking perspective, of course, it was a favorable cushion for them because they're able to pass these risk premiums to clients directly. So at some point last year, remember some banks were even charging upwards of 20-25% per annum on loans. And what's the more concerning matter with risk-based credit pricing is that, yes, the logic is that riskier borrowers should be charged a higher risk premium compared to the relatively safer borrowers. But the question now becomes, what's to stop banks from labeling all borrowers risky and thereby charging them a high risk premium? It's a low-hanging fruit at the disposal. So most of the credit was repriced from fixed loan or fixed rates into variable rates, which I think large number of consumers find pretty unstable because people like to plan around predictability. So if consumers do not know what the lending rate will be tomorrow, definitely demand has to take a hit.
A friend of mine here in Derry is telling me that he believes that the new loan pricing model from the central bank is more of a form of price control, interest rate control, and he saw how that worked out. Would you agree on that assessment?
I think it's a tactical compromise. Rather than giving banks the free rein to ultimately determine their benchmark and the risk premium, we are having a compromise both from the banking sector and the CBK. So the CBK is saying use a standard benchmark, but determine your K as long as you're transparent about it. Banks, on the other hand, want that freedom to determine their K. So I think it's a balance of both worlds because under the previous risk-based pricing, it was anything goes. Banks could charge even as high as 27% per annum. But now, given we have a common benchmark, I think we'll have a common basis of comparison of interest rates across banks. In as much as the switching costs are pretty high, the time it takes to build a reputation with a new banker, banks will have to play more competitively as before.
And then in terms of provisions, some banks cut provisions, others raised. Is that in line with the trends that you're observing across banks, who cut more and who cut less? And what does that mean?
I just mentioned briefly on the divergence in strategy we are seeing. Even the banks are not agreeing on the general market sentiment. If you look at the PMI indicators, you're starting to see some mild improvements, somewhat, going forward. In line with that, some banks have been increasing or rather decreasing their cost of risk, meaning they've been lowering their loan loss provisions. That allows banks to record slightly higher profit margins than before. And it implies that management is more optimistic on credit performance. Starting off, say, with Stanbic reduced loan loss provisions. If you look at KCB also reduced loan loss provisions by 60 basis points. If I look at, say, Equity Group also reduced their loan loss provisions by more than 2.5 percentage points. I&M Group slightly increased loan loss provisions by 30 basis points. Standard Chartered, on the other hand, reduced the cost of risk. Trust Bank slightly reduced by 90 basis points on a year-on-year perspective. And lastly, Cooperative Bank, they increased by 40 basis points. NCBA slightly increased their cost of risk allocations. So we're starting to see more divergence in terms of the management outlook, and this is expected. But in my view, I think to the extent banks will start repricing their cost of credit or loans and advances to the private sector in line with the Tesonia benchmark and the speed with which they align to this, then we should expect a decline in the non-performing loan ratio across the industry.
So Ronnie, now let's look at profitability. What drove profitability across some of these banks? Some declined. I saw Stanbic decline, Stanchart too, and them did grow significantly. So how are banks being able to pull up these profits in this tough economic environment? After that, we'll discuss the dividends.
In terms of profitability, we saw some neck and neck battle. Of course, if we look at the top two titans, Equity and KCB, Equity took the shine in this first half, registering a 17% year-on-year increase in profitability to around 34.6 billion, slightly overtaking KCB, which recorded a profitability of 32 billion. A lot of this, if you look at Equity, majority of the profitability came because of reduction in loan loss provisions, where they implemented a close to a 4 billion decrease in loan loss provisions. So that is what supported profitability by and large for Equity Group. But in terms of the operating incomes, KCB performed slightly better than Equity by 4% near growth compared to Equity 3%. In terms of the growth rate, to rank based on the growth rates and not the absolutes, the fastest growing bank was actually I&M Group, which grew by 35% year on year. Equity Group came in second, 17% year on year. NCBA Group was in third at 13% year on year. In fourth place, we had Diamond Trust Bank, 11% year on year, ABSA at 9%, Cooperative Bank at 8.4%, KCB, I mentioned 8%. The only bank where we witnessed a decline in profitability was Standard Chartered, which recorded a 7.4% decline in profitability. And this was largely caused by a decline in operating incomes. Because if you look at net interest incomes were down 7%, non-funded income was down 29%. So if you also look at profit before tax was down 24.8%. So by and large, it's only Standard Chartered which recorded a slowdown in profitability. The rest of the banks were able to mitigate the decline in net interest margins with cost management techniques that were able to preserve or maintain the cost to income ratio constant, if not a slight decline.
Stanchart, even though they recorded a decline in profit, they did issue a dividend, an interim dividend. How is that allocation to investors looking like across these banks in the first half of this year?
In as much as, yes, Standard Chartered issued an interim dividend, which was maintained the same as last year's interim of 8 shillings per share, I think the defining decision is usually at the full year result. Since even if we factor in the 8 shillings per share, it is still well covered under the net profitability of 8 billion. However, yes, it is a worrying sign. Usually, if net profit is declining by half year, it implies perhaps that the final dividend is likely to be much, much lower. And especially given the legal matter that is currently weighing on Standard Chartered's door at the moment, it's likely that full year dividend may even go lower than markets are currently pricing at the moment.
Given that our market is heavily reliant on dividends, would that then mean our bull run might be short-lived after all?
With regard to Standard Chartered, and as with many other companies right now, we are seeing increased risk of overvaluation. There is exuberant optimism in the market at the moment, which is leading a number of retail investors to overpay for a certain earnings profile of a number of companies. If you look even at the dividend yields at the moment, some are even trading as low as 4% dividend yields. So that definitely is a key metric or key indicator or slight overvaluation now. And I didn't think we'd be talking about overvaluations at the NSE, but it's becoming a more and more potent risk at the moment.
Yeah, investors have a really high appetite for buying shares currently. So looking at your analysis so far, are there any notable points on banks that you did note across their H1 results?
One of the factors that really impressed me was how Standard Chartered was able to reduce their non-performing loan ratio to as low as 4%. That's an industry first. For the most part, majority of banks are oscillating in the double-digit NPL ratio. So definitely that's an area where Standard Chartered stands out. It's definitely a strategy that should be studied by competitors. If you also look at their cost of risk, it's also very low at just 1.3% of the loan portfolio. So by and large, you can say the Standard Chartered asset quality really stands out across the industry. In as much as, yes, they've recorded a decline in profitability, they've really done their homework insofar as intensifying bad debt recoveries and in terms of the screening of credit even before issuance. Another theme that stood out that maybe I need to touch on was how some banks are still able to maintain elevated yield on interest earning assets. Standard Chartered again stands out as maintaining a very strong yield at 15% over the sum of all government securities and loans and advances. One of the things that stood out for Standard Chartered even last year was how agile they were in shifting their loan portfolio. So you find that Standard Chartered were very keen on selling all their low coupon or low earning assets and substituting that with high coupon securities. That is what really drove their yield on interest earning to as high as 17% in 2024. So right now they're still above their peers in terms of the yield on interest earning assets. And in terms also the cost of funds, Standard Chartered also has the lowest cost of funds in the industry at just 1.6%. So that gives them a very large double-digit net interest margin of 13.3%. So one may wonder, how then do they realize a decline in profitability? And the answer to that is that in as much as the yields on interest earning assets are high, they're just not investing enough. They're not invested enough because they're sitting with over 33% of assets invested in other assets like property, rentals, and whatnot. So I think that is what is impacting their numbers at the moment. If they could just increase their allocations to government securities and credit, then we should start to see an uptick in their operating incomes going forward.
I wanted to ask for about three specific maybe institutions, if you have any general comment and observation about how H1 played out for them. So one is KCB, and because they let go of NBK, how do you see that impacting them going forward? They also have ambitions for Ethiopia over there. What are some of your observations around KCB in that regard? And then the second one I wanted to ask is housing finance. How have they progressing? They did a capital raise last year and it seems like they're doing a turnaround there. And third, I wanted to ask about Stanchart and the case that they have. Is it 30 billion that it's at stake or 7 billion that is at stake over there?
Starting with KCB, which was actually the next bank I wanted to spotlight on. KCB is one of the banks that has really registered a decent turnaround. And it's one of the counters where I'm extremely bullish at the moment. I think it's one of the remaining banks that is still undervalued, despite trading at 50, 55, 53 levels as of today. Firstly, the sale of NBK could not come at a better time, given how elevated their non-performing loan ratio was. At some point, it even hit 20%. But right now, we are starting to see a turnaround. That ratio has declined to 18% of total assets. In terms of the net interest margins, KCB has also been very tactical in preserving their net interest margins. And this has been despite a decline in interest rates across the industry. KCB still managed to raise the yield on interest earning assets. And a large part of this had to do with the risk-based pricing benefit It's a point to note that KCB increased their allocations to loans and advances by as high as 600 basis points year on year, which is a tactical benefit because now if interest rates on credit still maintained or held at 18% levels for the most part, and government securities are declining from the 18% levels into the 12% range as they are currently. That tactical decision to increase lending really turned out in their favor. However, one other thing we've noticed is that we are seeing tightening funding costs despite the decline in interest rate. So customers are becoming more savvy. They're demanding a return for their deposits. So the CASA ratio has been definitely reducing. People are now opting into more savings accounts, money market fund solutions, as opposed to the normal current accounts that they hitherto used to. So the net effect of that was that the net interest margins held steady at 7.5, which was no mean feat given the book value they're handling. Another thing that stood out with KCB, the ROE is managed to improve from 21% to 22%. That's a percentage point increase, which I think places KCB on the path to more optimistic valuations, in my view. In my previous valuation, we think KCB has the potential to cross even the 70 shilling mark in 1 year's time. So that's one counter we think is underpriced, given the book value currently is at 95 shillings. I think investors can stand better off taking advantage of that discounted opportunity. HF Group was also another counter where we did witness significant improvements, and this built on last year's capital raise activity in the form of a rights issue, which was heavily oversubscribed. The net effect of that rights issue was that HF Group was now able to restore capital buffers above the central bank minimum. For the longest time, HF Group was trading below the central bank minimum, but right now they're well above that threshold. In terms of even the profitability growth, we noticed an astounding triple digits growth in profitability by half year, which is now compelling us to adjust our valuations on HF Group and how we classified HF Group. It's also important to note that HF Group was also promoted from a Tier 3 bank into a Tier 2 category. So I think HF Group is also another undervalued opportunity at the moment. We've seen already some decent improvement on a year-to-date basis in terms of valuations, but I still think there is a lot of runway to go in terms of up price to even the 30 shilling mark as per tentative estimates. So I think HF Group was one of those counters that the decision to make a capital raise and clean up a lot of the regulatory issues, especially with regard to the statutory minimum capital, has really set the bar up in terms of even, because if you look at even the organic performance, operating incomes are up by even as high as over 50% year on year. I can say HF Group is on the path to a decent recovery over the coming quarters, and it's a hot counter to definitely look out for. Your last question was with regard to
Standard Chartered and the pending case.
The pending litigation, yes. Of course, there is that aspect, because originally the amount being sued was 7 billion shilling back in 2009. However, the court ruled that amount be adjusted for inflation and basically cost of living adjustments and whatnot over the entire unpaid period. So if you are compounding the 7 billion at an average inflation rate of 5% for the next 16 years, that gives you a liability north of 16 billion Kenya shillings. But if you look at the Standard Chartered's capital of 53 billion, yes, they can definitely cater for that liability without breaching the CBK minimum regulations. But of course, wiping out a third of your core capital is not something you take kindly. So something you definitely have to give, and most likely it's the dividend. So that's why I was very pessimistic surrounding the full year dividend, given the decline in profitability and now this litigation knocking at the door.
From your assessment, what will be the way forward here? Is it a negotiated settlement somewhere between about 7 billion for this, or how do you see them go about this? And should investors be worried?
It's definitely a worrying sign given the length that Standard Chartered went even to the Supreme Court. However, the Supreme Court upheld the Court of Appeals ruling to the effect that the appeal to the Supreme Court is not constitutional interpretation affair. So basically, they had to comply with the Court of Appeal ruling going forward. And given how heated and how prolonged this court case has been, I think it would be the best case for Standard Chartered to just count the loss and pay the full adjusted liability without negotiation, because again, that will trigger another court case, which I don't think Standard Chartered would want to head into.
Do you think they have provisioned for this in the past? That's one question that investors have also been asking.
When I look at the provisions, I don't think it was enough to cover the 16 billion liability, because their provisions are just at 6 billion at the moment. And that's just for bad loans. So they'll definitely have to draw down from their core capital, which is currently standing at 52 billion.
That's pretty significant. That's something to watch as we head into the second half of the year. So just looking across board, anything else that we may have missed you want to just discuss here and there? Maybe especially KCB's entrance to Ethiopia. I don't know if you covered it fully, but there's some worry among investors that Ethiopia is a bit of a tricky market for some of these institutions that head there. At one point, there was a CEO who was being asked how their entry to Ethiopia was going on, I think in the late 2000s, and their response was that it was painfully slow. So what's your assessment of banks being interested in Ethiopia?
Thank you for that characterization. I think, yes, Ethiopia is that one market that players are usually so optimistic about, and it's usually pegged on the population, right? You're looking at an over 100 million population market, which seems like a low-hanging fruit, but there are nuances to its market. For one, you find in Ethiopia, unlike here in Kenya, where Kenyans tend to concentrate around urban and peri-urban areas, in Ethiopia, the population is much more dispersed. So if it means building that branch network coverage, the capex will definitely have to be no mean feat. You'd be looking at a double-digit billion budget to set up all those branches to cover that population, which is so dispersed. However, yes, we know that KCB have already received approvals from the Bank of Ethiopia to set up shop in the market. They currently have a representative office, but I think Ethiopia is that one market where you have to take a patient approach. I think we've seen other players move here with a lot of optimism, only to realize that good things take time. So in terms of the breaking KCB to make that tactical decision to enter Ethiopia, I think the rewards from that decision will come many more years ahead. Certainly not in the first 5 years, but maybe as you approach year 10, or let's say even year 7, if I'm to be more optimistic, then that's when we'll start to see some demographic dividends, given the capex they'd have to undertake to build that branch network reach.
I think their consideration currently is not like setting up. It looks like acquiring a stake in an existing bank. Would that change your perspective there or analysis?
Oh yeah, that is also an alternative on the chopping board. Certainly acquisition comes with a less headache. You just have to maneuver board dynamics. And it's also a requirement that if you are setting up shop in Ethiopia, then you need Ethiopian shareholding as part of your entire shareholding structure. By and large, yeah, I think acquisition would come with much more benefits because you're relying on partners with on-the-ground expertise, and you'll avoid that kind of anti-nationalistic sentiment that, say, for instance, they witnessed in Tanzania when KCB was entering Tanzania, and they coming in with this KCB brand, Kenya. Perspective by ordinary Tanzanians is like, that's a Kenyan bank, and they're coming to play in our market. So you want to avoid that kind of nationalistic sentiment because it's not good for business per se. So I think an acquisition is much more better, smoother in my view. I think it would be a more strategic decision to take.
Couple of questions have come in here. The first question is about capital. Justice here is reminding us about the core capital requirements where banks are being raised a bit step by step until 2029 to 10 billion. And then also at the same time, there was the fact that there was a moratorium on the registration of banks that was placed, has now been lifted also. So what are some of your assessment on developments around the banking sector as regards capital requirements? Would there be mergers and acquisitions? We know that Stanbic has been in the market, I think, for the last 2 or 3 years looking for some acquisitions to make. Do you think there are some banks which are ripe for acquisition?
I think yes. With regards to the raising of the minimum capital requirements for the entire banking sector, I think given the global standards across, even starting with our neighbors here in Uganda, their minimum capital requirements are way higher. And having such a standard sets the industry up for more confidence less systemic risks and liquidity risks compared to the status quo. What I like about CBK strategy is that they've given a well extended duration of time, or let me say a staged ladder towards meeting that requirement. By 2027, they are required to be at 3 billion. So I think that gives the tier 3 banks some adequate time to build up their capital reserve positions. However, we are more likely to see at least 2 or 3 acquisitions appear by, let's say, the tier 1 counterparts of their tier 2 or maybe tier 3 counterparts. However, for the most part, I expect majority to meet the 10 billion. I don't think it's a very high threshold, given, of course, I know 15 banks currently are below the minimum, but I think given the duration of time afforded them and the lifting of the moratorium of foreign banks coming to set up shop, we're likely to see more even global partnerships. Global banks looking to set up shop may even acquire some of these underfunded shops. So likely, I expect or I anticipate at least 2 acquisitions on the local scene and another like 3 or 4 acquisitions by foreign banks or foreign shops. But the majority, so let's say a third, I expect a third of the underfunded banks to be either acquired locally or offshore, and the remaining 2/3 to actually meet that minimum threshold of 10 billion by 2035.
1 or 2 questions here, and then I give you a chance to give your closing thoughts. So someone, Kev, is asking what's been the bank's performance on return on equity, and what some of the product lines that you think would drive growth in net interest margin in the second half of the year. And then Jan is asking how much of the first half profit growth across banks was real operating income versus accounting relief from lower provisions. Those 2, and then you give us your closing thoughts in terms of outlook for the second half of the year.
If I'm to commence with the ROE question, we've seen decent improvements across the industry. It's only Standard Chartered which registered a decline in the net profitability and consequently the ROE. But by and large, most banks still maintain double-digit ROE. Standard Chartered is still number 1 at 27% ROE, despite the decline in profitability. In second place, we have ABSA at 24.5%, basically 25% ROE, which again, we are seeing the multinationals still maintain the lead. In that place, we have NCBA at 23.2%. In fourth place, we have BK Group, which is their Rwandan shop, but they don't have banking operations in Kenya presently. In fifth place, we do have Equity Group at 18.6%. In sixth place, we have Standic at 17.6%, Cooperative at 17%, I&M at 16.4%, KCB, I mentioned it, in that place at 21.1%. So in last place, it's HF Group. So they still need to do much more to improve their ROE position. It's currently the lowest. Above it is Diamond Trust Bank at 9% ROE. So the reason why valuations are not improving beyond parent levels has to do with the ROE of HF Group. Despite the overcapitalization and the triple-digit growth in profitability, still got some homework to do.
Jerry is asking whether those are on closing or opening equity, the numbers.
It's a weighted average of opening and closing equity.
And then there's always a discussion around DTB and the ROE. Would you want to elaborate that a bit before you give us your closing thoughts?
Yes, I think DTB is one of those banks that usually we start to see a lot of good momentum in the first 3 quarters of a financial year. But then I don't know, something happened in the last Q4 that suddenly fizzles out all the momentum and they end up at single-digit ROE. Because on a trailing basis, so far their EPS is up 14% year on year. But as I've seen over the last 4 years, Q4 is usually a very unique quarter because we tend to see all that momentum fizzle out and they just record a single-digit growth in profitability. I don't know precisely what happens, but if I look at the operating incomes are growing steadily. So a lot of the fizzling out of the momentum has to do with the increasing of the credit loss provisions that happens at the final quarter.
Your closing thoughts now.
Great. It's been a real pleasure once again. And I thank you, all members, for your indulgence and your questions. I think the banking sector going forward is poised for renewed era of, 1, lower for longer interest rate. I do anticipate, while bank may take a very long time to adjust to the Kesonia benchmark, over time, I think we have a progressive DTM NPL ratio across the industry. But of course, we are not so far from, again, another election cycle, which tends to dampen optimism. All our expectations are that given the current stability in rates and on the FX space, we should expect average single to double digit growth in net interest margins. I expect non-funded income still to lag or maintain a very weak growth compared to last year and the year before, where growth in non-funded income used to exceed growth in funded income. In terms of the operating expenses side of things, I think most banks have really tried to contain growth in expenses. This has entailed even reducing the branch count, in some cases even staff count. And if you look at their investments into digital banking, it's paying off much, much more. It's an expense that pays off much, much more in terms of the interest income, reducing costs, and the scalability has been immense. Some banks like KCB right now have 99.8% of their transactions happening outside the branch network. And already they have about 2,000 branch counts across East Africa. So that tells you the evolution of our financial market. Consumers are becoming more savvy in terms of how they engage with financial products. And that is translating into efficiency margins or efficiency dividends for these banks. In terms of the expectation, the banking scene, in terms of the acquisitions, the activity, yes, I said I expect some few activity, let me say, on the spot activity, basically a third of the underfunded banks is what I expect to be acquired. But I expect, given the timelines extended to these underfunded banks, majority to be able to meet that 10 billion mark by 2035.
Thank you so much, Ronnie, for taking an hour of your time to give us an analysis of banks. I will look out for you maybe in Q3 and then the full year again to discuss this more and see some of the insights you have gained along the way.